Alright guys, we're going to go ahead and get started. It looks like we have the majority of the registrants on today's webinar, so if anyone comes in late or you miss a couple things or have to leave early, we will be doing a recording of this, so feel free to check your email if you missed anything and you can follow back there. Today's webinar is Accounting, Taxes, and Payroll Essentials to save business owners thousands each year. We're going to be talking about a lot of different topics today, including teaching you how to structure your business to maximize tax savings, how to truly streamline your financials to bulletproof yourself from an IRS audit, and how to utilize a strong bookkeeping system to help your business succeed. We'll also be touching on many more topics. That's just the beginning. To start off, let me introduce myself. My name is Mike Jesowshek. I am a CPA and registered tax planner, as well as the managing partner over at JETRO and Associates. And for the past 10 years, my mission really has been to teach tax saving strategies that are used by super successful business owners to help maximize profits for small businesses and avoid getting crushed by the IRS, while also helping you grow your business at the same time. Today, I'm going to talk about some of those strategies that we've learned throughout the years. Now, before I get too far into it, I just want to give a fair warning. Everyone's needs are different and no tax situation is the same. So what we discuss here today will be general tax saving strategies. But it's important to know that you should discuss these items with a tax professional regarding your specific situations prior to implementing any of the strategies that we talk about. And finally, this is definitely not for someone that's trying to defraud the government of taxes. This webinar today is not about tax dodge, Swiss bank accounts, or shell corps. This webinar is about leveraging tax laws and loopholes that are naturally built into the system to help make sure that your business is maximizing every opportunity available to you to help cut your tax liability. Now, an IRS audit may be one of the biggest fears for almost every American. And what I really want to do is make sure that you are able to avoid an IRS audit while also bulletproofing yourself from that happening. So first things first, open a separate bank account. And when you start a new business, it might be easy to just pay for all the startup costs and expenses out of your personal account and then figure it out later. However, this can really be sloppy and cause a lot of confusion and possible misreporting down the road. As a new business owner, it's vital to open that separate bank account for your business, which will allow you to have a clean record of business items and just make sure that there's no commingling of funds with your personal account. Next, it's very important to keep great records and receipts. Keeping good records allows you to defend your business expenses, and this is where really having a fundamentally strong bookkeeping system comes into play. And while you're keeping, that solid record of activity in your bookkeeping system, you should also be saving receipts. Now, I'm a cloud-based guy, so to me, there's really no reason to hold on to paper receipts for years when you can simply take a picture of it and upload it to online for storage. There's even software out there, HubDoc, Receipt Bank are examples, or even your cloud-based bookkeeping software. These softwares allow you to upload the receipts directly into their platform. You basically take a picture and it's onto their your file system. Ditching the paper allows for just a much easier, cleaner, easier to find bookkeeping environment. But regardless of how you decide to keep your receipts, be sure to keep record of the basic items. The who, the what, the where, the when, the why, the how much. Not only does this help back up the business purpose of that expense that you made, but it reminds you, in case you forgot down the road, really what was that dinner for, or who did you go to dinner with. These items are easy enough. Just put them on the receipts, keep record of them so you have them down the road. Ditch the cash. As part of having good receipts and good records, you want to make sure you have everything documented with a trail. For that reason, we really tell our clients to avoid cash transactions as much as possible. Cash is really hard to track and can really lead to a lot of questions if you were to get audited by the IRS. So we just recommend stay away from it as much as possible so that you know that if you do get audited, you can back it up with an actual transaction. In the rare event that cash is your only payment option, just be sure to get a receipt so that you can properly document that business expense with that receipt. Verify book income matches 1099Ks received. Now, this is for people that do credit card processing. Basically, your merchant processors will send you a 1099K at year end, and that 1099K really represents the amount that was processed to you throughout the year. A copy of this also gets sent to the IRS. But where it's important is that you verify that the income that you report to the IRS on your tax return includes all of the items that are also on the 1099K. Otherwise, if you report income on your tax return below the 1099K amount, it would be an immediate red flag to the IRS. And there's a lot of reasons why they might not match. For example, the amount that you actually received might have merchant fees, refunds, chargebacks that get subtracted from the sales prior to it being deposited into your bank account. So for example, you might have a sale, let's say $150, but you only physically in your bank account receive $142 because the processor took their fees out prior to sending the money to you. However, that merchant processor is actually reporting that $150 to the IRS, not the $142. So basically, you just have to be sure that you are aware of this issue and that you can make an adjusting entry at year end to account for those expenses that you might not have included in there, as well as bump up the income so that it actually matches what your actual sales were that are offset with those expenses. Another thing, file on time. This may sound silly, but simply don't file a late tax return. If you need to extend, that is definitely not a problem. Just make sure that your extension request is filed in time, along with that your final return is then filed by the extension due date. If you're operating as an S Corp, be sure to pay yourself a reasonable salary. If you don't really know what that means, don't worry, hold tight, we will be discussing that a little bit later. And if you have workers that you hired, make sure you are treating them properly as employee or independent contractors. And that's what I'm going to talk about next. So, in independent contractor versus employee, this is a topic that many business owners overlook or don't even realize is important. So, I'm going to start with the IRS definition of an employee, which is anyone who performs services for you if you can control what will be done and how it will be done. This is so even when you give the employee freedom of action. What matters is that you have the right to control the details of how the services are performed. Now, like many things the IRS does, that doesn't really tell us much. But we should understand the biggest determination between an independent contractor or employee really comes down to control. Do you as the payer control what will be done and how it will be done? Now, to help illustrate that, I'm going to go through a series of questions that we used with a fitness studio client of ours. So if you answer yes to these questions, generally it means that you do have control and the worker should be classified as an employee. So question 1, does the studio establish the training programs and design the workouts? Do clients pay the studio, not the trainer, for their sessions? Does the studio determine the price the clients pay? Does the studio set the class times? Does the studio pay for training equipment and supplies? Do the trainers work under their individual name and not a separate business? Do you intend for the trainer to work at your studio for a while and not just temporary work? Now, as you can probably imagine, a typical studio would likely answer yes to many of these questions. I'm going to go through a few characteristics of what an independent contractor, might be. The worker has their own business and they perform services for many other studios or on many other businesses. They design their own training programs outside of the studio's control. They determine their own schedule and pricing. They bring their own clients into the studio, and they also provide their own equipment. So these are things that independent characteristics that an independent contractor might have. So when it comes down to it, what I tell clients is that after reading the facts, if you really feel that your workers should be classified as independent contractors, definitely take advantage of that and pay them that way. If, however, you believe your workers should be employees, but you instead choose to treat them as contractors, just consider the risk you are taking and maybe try to rethink your options. I often get people that say, well, my friend who owns a business does it this way, or I'll just fly under the radar, or the worker requested to be an independent contractor. And really, my response to those clients is that just because one business does it one way doesn't mean it's correct. Or their answers to those questions may be completely different than yours, or maybe they're just hoping to not get caught. And you might also think that you can fly under the radar, but you are not actually just going up against the IRS, but also the state. And as your business grows, the potential penalties, fees, fines, back taxes, those will just continue to add up. And what I say about the worker requested to be an independent contractor is that if you get stuck in an audit and the state or IRS determines that worker should be an employee, you are the one that gets stuck holding the bag, not that worker. So again, look at the circumstances and just know the risks that you're taking and have something to back up. If you do go an independent contractor, keep some records. Keep some records on why you decided that, so that these can help you in the event that something comes up. Next topic, sales tax. I just want to talk briefly on sales tax because I know a lot of small businesses have questions on it. First, there's no federal sales tax. Sales tax is only imposed on the state and local level. So that means that every state and every locality may have different tax laws or sales tax laws and rules that need to be followed. So it's important to note that even if a state does not have a statewide sales tax, there may still be a locality within the state that does levy a sales tax. Now, whether you have to pay sales tax or not really comes down to nexus. And generally stating, having sales tax nexus means you have sufficient physical presence within a state or locality, thereby requiring you to comply to the sales tax laws there. Now, you're probably wondering, how do I know if I have nexus? And there are 3 kind of general guidelines to help answer, do you have nexus? And again, for these, I'm going to go through these and give you a couple examples. And for the examples, I'm going to use that same fitness studio client of ours. So first one is property and location. If your business is physically located in a state, that would qualify as nexus. So as an example, a fitness studio with a physical locations in Oklahoma City, Dallas, and Memphis would have sales tax nexus in Oklahoma, Texas, and Tennessee. The next one, people. If you have employees in a state, that would qualify as nexus. So let's say you have a fitness studio physically located in Dallas, but you also have this virtual instructor in Miami. You would have sales tax nexus in both Texas and Florida. And the third one, inventory. If you have a warehouse or inventory in a state, that would qualify as nexus. So an example, fitness studio in Dallas, but you created your own type of protein drink, and for fulfillment purposes, you decided, let's say, keep that drink inventory in San Diego. You would have sales tax nexus in both Texas and California where your inventory is. So if you do have sales tax nexus, you feel like you have nexus, you might say, okay, now what do I do? And the next thing you need to do is register for a sales tax license or permit in the states that you do have nexus in. This, by having that permit, it'll allow you to begin collecting sales tax from your customers. And it's important that you also, again here, file your sales tax returns by the required due dates. And this can really change and be different from city to city, state to state. Usually it's monthly, quarterly, or annually. And another thing to note is that even if you have no sales for a specific period, you still need to file a 0 return. So when it comes to sales tax, this is some very basic stuff. And what I say is that depending on your specific situation and your locality, if you're having troubles determining if you have nexus or determining what the rates are, do some research, make sure you are collecting the correct amount, and reach out to a sales tax professional if you need that, further assistance. Okay, so one of the most important topics for today, designing a bookkeeping system. Really, having a solid bookkeeping system should be the number one thing on every single small business owner's checklist. There are so many benefits to having a solid bookkeeping system that's really not worth losing out on. And the first thing that I recommend when it comes to a bookkeeping system is utilizing cloud technology. We're no longer in the 90s, so it's really time to upgrade your accounting system to the cloud. One of our favorite cloud bookkeeping software is Xero, but there's many others out there. QuickBooks Online, Wave, just are some examples. So not only does moving to the cloud give you access to your financial data anytime, anywhere, it also allows you for easy collaboration with an accountant or anybody else that may need access to your books. You'll never have to worry about backing up a file or making sure you have the right computer with you. And another beautiful thing about cloud software is that it is so easy to integrate with other cloud bookkeeping or other cloud-based software. So if you have a certain functionality that the basic cloud software doesn't have, there's likely an add-on partner that will integrate directly with your bookkeeping software to give you that solution. Next, it's vital to keep your books current. Having a bookkeeping system is not just important when it comes to tax time, but it really can help run your business more effectively throughout the year. And the key part here is that your bookkeeping has to be up to date. We recommend doing your bookkeeping on a monthly basis just to avoid getting too far behind. And if you just leave your bookkeeping sit with no ongoing activity on it, it's really not useful for you. So just make it a point to always keep your bookkeeping up to date so you can utilize that information for growing your business, planning ahead. Which gets me into the next point, planning for expenses and taxes. As you're doing that monthly bookkeeping, be sure to plan for future expenses and taxes. Create budgets, projections, so that you can better understand your business's cash flow to plan for the future. And since another thing is that now that you're self-employed, it's important to understand that you are responsible for paying the IRS and state taxes, not your employer or someone else. So when you're doing those budgeting and projecting, factor in that cash that will need to be used to help pay for your personal taxes. All right, now we're on to the tax portion of today's webinar. The number one mistake we see small business owners make when it comes to taxes is simply failing to plan. I don't care how good you or your tax preparer are with a stack of receipts on April 15th. If you didn't know you could hire your kids or implement some other tax planning strategy, there's nothing you can do at that point. That's just preparation, and that should be the last and least significant part of taxes. Tax planning is really about giving you a plan to help minimize the taxes that you're paying. What should you do? When should you do it? How should you do it? And tax planning really gives you two more powerful advantages. First, it's the key to your financial defenses. Now, as a business owner, you really have two ways to put cash in your pocket. Financial offense is making more money. Financial defense is spending less. And for most of us on this webinar, taxes really are our biggest expense. So it makes sense that we should focus our financial defense where we spend the most, which is taxes. Second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business, and I'm not saying that you shouldn't, but that can't guarantee results. You can organize your company correctly, hire your kids, do tax planning, and now you're guaranteed savings. So financial offense and financial defense should both be completed. But it's easy. This financial defense part, tax planning, is easy to implement in every small business. When it comes to taxes, the most important and bottom line thing to understand is you lose every time you spend after-tax dollars that you could have been pre-tax dollars. So let me repeat that one more time. You lose every time you spend after-tax dollars that could have been pre-tax dollars. When it comes to tax planning, there's four main buckets of strategies you can use to help cut your tax bill. Timing-based strategies, and this is like using a 401k deferral to shift today's tax bill to tomorrow. Income shifting strategies to move taxable income to lower bracket taxpayers like your children or grandchildren. Code-based strategies, and this is like a Section 105B that may let you deduct your family's medical bills as a business expense. And product-based strategies like separately managed accounts and insurance. One of the biggest mistakes, especially for small business owners in taxes, is choosing the wrong business entity. Most business owners start out as sole proprietors. Then as they grow, they establish an LLC or corporation to help protect them from business liability. But choosing the right business entity involves all sorts of tax considerations as well as that liability. And many business owners are operating with entities that may have been appropriate when they were first established, but just simply don't work as effectively now. The main problem when it comes to small businesses and tax that we're looking to solve is too much self-employment tax. If you operate your business as a sole proprietorship or a single member LLC taxed as a sole proprietorship, you will report the business net income on your personal return via a Schedule C. The net income, the full amount, is subject to income tax at whatever your regular rate might be, but you'll also pay self-employment tax at a 15.3% rate on that full net income amount. So for example, let's assume your business profited $80,000. You'll pay tax at whatever your regular rate might be, but you'll also pay over $11,000 in self-employment tax. And what this self-employment tax replaces is the Social Security and Medicare tax that your employer would typically pay and withhold on your behalf. Now, this right here, what we're going to be talking about now, is our number one tax saving strategy that we recommend to 95% of our clients, and it's the S Corporation. The S Corporation can be an LLC or C Corp. It is simply a tax election. So an LLC or C Corp would just be elected to be taxed as an S Corporation. What the S Corporation does is it divides the business net income into two halves, one of which is not subject to self-employment tax. So one half is your company will pay you a salary for the services you perform as an employee. You'll get a W-2 for that amount, just like any other employee that you have, and the rest of the income the remaining net income will pass through to your personal tax return as a dividend. So you'll pay regular income tax on both halves, the salary, the income, the full net income, just like you did with your sole proprietorship. You'll pay self-employment tax in the form of FICA withholding on the amount that you take as a salary. It's that same 15.3% that you paid as a sole proprietor. But here's where the magic happens. You'll avoid self-employment tax entirely on the amount that passes through to you as a dividend. So again, you'll avoid self-employment tax entirely on that amount that passes through to you as a dividend. So to help that make a little bit more sense, let's look at some real numbers to see what type of savings we can create. A minute ago, we looked at a business owner earning $80,000 as a sole proprietor, paying over $11,000 in self-employment tax. Now, let's imagine that we take that same business and instead have it taxed as an S-Corp. While doing that, you decide to pay yourself a salary of $40,000. Just in that instance, you will save $5,184 in self-employment tax. This is especially valuable because in this strategy, we're simply eliminating a tax. We're not asking you to put $5,000 into a retirement plan and then deduct it. We're not asking you to take $5,000 and buy new equipment and then deduct it. We're simply avoiding that $5,184 in self-employment tax. Another thing to know is that this is something that happens. This is not just a one-time savings. This is a savings that you will see each and every year as you operate as an S corporation. Now, let's look at the fine print a little bit, because I already know what you're thinking, or what some of you might be thinking is, why not pay a zero salary or a ridiculously low amount like $1,000 a year? Well, the rules require that you pay yourself a reasonable salary for the work you do as an employee. Unfortunately, the IRS, again, does not make it easy to determine what a reasonable salary is. The IRS and tax court looks at several factors when there's a dispute over reasonable compensation, and these include the nature of the business, you as the employee, what are your qualifications, responsibilities, how much time are you spending on the business, what is your compensation compared to other employees of yours that aren't shareholders, and what do other businesses pay for your services? Other businesses in the same industry, what would they pay someone like you, that you complete for your services? So every year the IRS publishes spreadsheets reporting all sorts of mind-numbing stats. One of the stats that they report includes the average amount of salary that S corporation owners in aggregate pay in the form of officer compensation versus the amount they take as dividends. Previously, that percentage was 32%. Now, I'm absolutely not suggesting you take that percentage as any sort of guideline or safe harbor. However, I do want you to see that using the S Corp to minimize employment tax is a well-established mainstream planning strategy. If you do need help finding out what that reasonable salary is for your specific job, there are companies out there that can help assist this and give you some documentation that will help back it up in the event of any type of audit. And while we're talking about some reasonable salary, let's cover some nuts and bolts about an S corporation as well. First, as mentioned, you need to have either an LLC or a corporation set up with your state, and then you also need to have an employer ID. Once you have that, and most of you probably already have this, you can file the actual S Corp election on a form 2553. Filing this S Corp election is pretty straightforward. Once your S Corp is all official, you'll have some ongoing paperwork requirements. You'll need to start filing payroll returns. Now, if you already have employees, not a big deal. You're just adding yourself to the returns you're already filing. You'll also need to manage state unemployment and workers' comp premiums, which, again, if you have employees, this is already being done. But important part here is you'll have to adjust your estimated taxes to help reflect that amounts that you'll be withholding from your paycheck now that you are an employee. And then again, at the end of the year, you'll need to prepare a W-2, a W-3, along with a federal unemployment return. Again, if you have employees, you're already filing this, nothing new. You will also need to file a business return with the IRS and state. And then there's also, with any LLC and corporation, there's some formalities with the state that you must continue to work out. And these are things that, these corporate formalities, this would be board of directors meetings, very basic, easy to do things, but it's important that you just document them so you have that as your record. So in the end, there is a little bit more work involved for the S corporation, but the continuous tax savings that you can really see from it is much worth it. Now let's talk about some retirement. So if you're looking to save more than the $5,500 limit for IRAs, you really have three main choices: simplified employee pensions or SEPs, simple IRAs, or 401ks. Now, I'm not here to make you an expert on retirement plans, but I do want to talk about the SEP a little further because it's a very powerful strategy, especially for solo owners. The SEP is the easiest plan to set up because it's really just a turbocharged IRA. If you're self-employed, you can contribute up to 25% of your net self-employment income. So that amount does not include the SEP contribution itself, which means you can actually contribute 20%. If your business is incorporated and you're salaried, you can contribute 25% of your covered compensation, which is roughly the same as your salary. The maximum contribution for 2017 was $54,000. If you've got employees now, you'll also have to contribute for them. You generally stating have to contribute the same percentage for your employees as you do for yourself. However, you can use what's called an integrated formula to make extra contributions for higher incomes. This money that you contribute goes straight into an employee IRA account, and there's no annual administrative or paperwork required. The SEP is easy to adopt, easy to maintain, and flexible. It's really easy. If there's no money to contribute, you just don't contribute that year. The contribution, however, is still limited to a percentage of your income. So if you set up an S corporation to help limit that self-employment tax, you may also be limiting your SEP contribution because it's only allowed 25% of your salary. Okay, now let's talk about another tax-saving strategy opportunity: family employment. Hiring your children and grandchildren can really be a great way to cut taxes on your income by simply shifting that money to someone that pays less in tax. There is a minimum age, for now at least. They have to be at least 7 years old. Their first $12,000 of earning income in 2018 is taxed at zero. And that's because it's the standard deduction for a single taxpayer, even if you claim them as your dependent. So you really can shift a lot of income downstream. You do have to pay them a reasonable wage for the services they perform. And the tax court says a reasonable wage is what you'd pay a normal vendor for the same service, with a slight adjustment made, to account for the child's age and experience. So let's say your 12-year-old son cuts grass for your rental properties. Pay him roughly what a landscaping service might charge. If your 15-year-old helps keep your books, pay them a little bit less than what a bookkeeping service might charge you. To help audit-proof your return with this strategy, write out a formal job description and keep a timesheet. You will have to pay by check or digitally so that you can help document that payment. And you must deposit the payment into an account in the child's name. But here's the key. It doesn't have to be their pizza and Nintendo fund. It can be a Roth IRA for decades of tax-free growth. It can be a Section 529 college savings plan. Or it can be a custodial account that you control until they turn 21. Now, with the custodial account, you can't use the money in that for your obligations of parental support. But, and now this is key, private schools or sleepaway summer camps, those aren't obligations of parental support. So let's say your teenage daughter wants to spend 2 weeks at a horse camp. You have one option. You can earn the fee yourself, pay taxes on it, and pay for the camp with after-tax dollars. Or you can pay your daughter to work in your business, deposit the check in her custodial account, and then as you, the custodian, you can use that money in that account to pay the camp. Hiring your daughter in that scenario effectively lets you deduct her camp as a business expense. If you hire your children to work in an unincorporated business, you don't have to withhold for Social Security until they turn 18. So this really is tax-free money. You will still have to issue them a W-2 at the end of the year, but this is really painless compared to the tax you'll waste if you don't take advantage of a tax or of an opportunity like this. All right, so now I want to talk a little bit about the Tax Cuts and Jobs Act. I don't want to go too deep into this new tax plan because that could be a series of its own webinars. However, I do want to hit on some of the very high-level items that are important to small business owners. For business owners, the Section 199A deduction is important to know about. In a nutshell, the Section 199A pass-through entity tax cut gives the owners of pass-through businesses, and this would be sole proprietors, partnerships, S corporations, real estate investors, it gives them a deduction equal to 20% of qualified business income. So let's use an example. You're an S corporation shareholder earning $100,000 from the company. you will get a $20,000 deduction. And again, this is a very simplified example. Now, if you're single with taxable income of $157,500 or more, or you're married filing jointly with taxable income of $315,000 or more, things do get a little bit more complex, and I would just recommend you dig a little bit deeper, spend some research on it to see some of the possible restrictions that may apply to you. Other changes, the corporate rate. Now, there's probably not too many C Corporation owners on this webinar, but I did want to mention it. The corporate rate is now a simple flat 21%. Entertainment expense. Now, here's, folks, is probably a change you are not going to like. Under the old rules, you could deduct 50% of the cost of business-related entertainment expenses. This included face value of tickets to sporting events, theater events, food and beverages, parking, taxes, tips, the whole 9 yards. The new law repeals that deduction, regardless of what business entity you choose to operate under. Business meals are still that 50% deductible. There's just no entertainment costs. Bonus depreciation. With the new law, businesses can claim 100% bonus depreciation for qualified property placed into service between September 27th, 2017 through December 31st, 2022. Generally stating, qualified property means anything except real estate and land improvements. This can apply to both new and used property. And finally, net operating losses. Now, in an ideal world, your business would make money year after year and tons of it. But we don't always live in an ideal world, and sometimes businesses lose money. If your business spends too much money in a year, or spends more money than it makes in a specific year, that is what you would call a net operating loss. And while nobody wants to lose money, a net operating loss isn't just something that gets wasted. It can help you really save taxes in a different year, so you can offset it in the future. The new law makes 3 changes to the net operating loss rules. The first change, it eliminates the 2-year carryback period, which is previously allowed. Previously, you could take that net operating loss and carry it back 2 years. It lets unused net operating losses be carried forward indefinitely. Used to be limited to just 20 years that they could carry them forward. And finally, it limits the net operating loss deduction for future years to 80% of that year's taxable income. Okay, so we covered a bunch of different topics today in a relatively quick webinar, but I wanted to get some really key things in front of you. And most of these topics that we talked about are just scratching the surface. But some of the biggest takeaways I want you as a business owner to retain from today's webinar and research further are: start tax planning now. You can utilize various strategies available to you and your business to help save thousands each and every year. Next, develop and maintain a solid bookkeeping system. This will be the core of your business's success, and it will help you bulletproof yourself from an IRS audit, as well as make tax season a breeze. It'll also help you grow your business and assist you in understanding of how your business is performing and where you can really improve. If you missed any of the items we just talked about today, or want to hear them again, or want to revisit someone, show it to someone else, there will be a recording. So definitely take some time to go through the items that are important to you and your business, and spend some more time looking into it in more detail. If you're looking for more information from us, or interested in how we can help you out with accounting or bookkeeping, tax planning, tax preparation, payroll, etc., do not hesitate to check out our website, and it's www.jetrotax.com. You can also email me directly at mjesowshek@jetrotax.com. And if you want to jump on a phone call with me, you have a question, you want to look into things further, you can schedule a call with me using my Calendly link, which is calendly.com/mjesowshek. Either way, I really hope I was able to help you out and start getting some gears moving in the right direction, so you can be on your way to tax savings and really having a lot of business success. Again, there will be a recording of this, so feel free to check your emails for that. I appreciate everyone for jumping on today, and I will stay on just a bit longer for any questions you may have. Other than that, everyone have a good rest of your day, and I look forward to talking to you guys soon, and have a great year.